Welcome to the Lifestyles Unlimited Real Estate Investor Radio Show, a real estate investment program. Listen and learn how to use real estate to build wealth and passive income streams for you and your family. We bring you experts every day to discuss and answer your questions on everything from single-family homes all the way up to 600-plus unit apartment complexes. And now, the Lifestyles Unlimited Real Estate Investor Radio Show.
Happy Sunday. Welcome to the show. I'm your host, Mike Harrison. As always, we're working on your financial freedom. Happy to be with you this morning. Well, my friends, what if I told you that you could grow generational wealth in your spare time? And while growing that wealth, you created monthly passive income. Tax-free passive income, I might add, when done correctly. Well, my friends, I think you'd be interested, and I think you'd want to know how. Well, that's what we do at Lifestyles Unlimited. We teach you the how. We invest in real estate. We buy houses. We rehab them. We fix everything. We make them the best product, best price. And then we lease them to great residents. And in doing so, we create passive income, monthly cash flow, month in and month out. But here's the thing. The majority of us that started doing this did so and continue to do so while having a full-time job. We're not taking on another job by any means. This is what we do behind the scenes. This is what we do in our spare time. Now, do many folks grow their wealth to such a degree that they can then retire? Absolutely. We call that financial freedom. And a lot of people are able to achieve this in just 3 to 5 years following our plan. So how do you retire? Well, financial freedom is when your passive income meets or exceeds your monthly financial obligations, right? If you need $3,500 a month to cover everything, right? House note, car note, electric bill, groceries, discretionary spending, what have you. If that's $3,500 a month and your passive income is $4,000 a month, do you need to go to work Monday morning? The answer is no. You can still continue to work, and many of us do so. We have that double barrel income then, right? We have the passive income on one side, and we have the W-2 income on the other side. And all that does is it means that we can then save and invest at a more rapid pace, right? We can grow it faster and faster. But that's, in a nutshell, essentially what we're doing is we're investing. But it takes money, my friends, okay? This is not a get-rich-quick scheme by any means. This is a time-tested, proven method of investing in real estate. We didn't invent it. This is nothing new. People have been doing this for decades and hundreds of years. But we need that down payment to buy those single-family homes, or we need that cash essentially to invest in apartment communities, those of us that choose to do the apartments. And there's a lot of options, right? You can do the single-family home. You can invest in apartment communities as a passive. You can buy your own apartment community, and I have several friends that own apartment communities, right? They're independent rental owner, IROs. And then you can also be a lead investor, and a lead investor grabs a pool of passive investors, and you pool your resources, and together you buy an apartment community. But again, it takes money to do what we do, okay? Doesn't take a lot. You can get started with as little as $25,000 to $50,000. But again, this is real investing. But the question is, what happens once you've spent essentially or invested all of your funds and you no longer have any of those essential seed funds to continue to invest? Well, you can save. You can save until you have enough to get into another deal. And depending on how much income you have coming in or passive income you have coming in, that could be a very short time, or that could be a year, maybe 2 years, maybe 3 years if you're just starting out. Or you can borrow, right? You can borrow and continue that investing path. Now, there's some rules wrapped around this. And if you caught last week's show, the last part of it, I was talking about borrowing to invest, but I've received so many emails on that. I need to continue this discussion about borrowing to invest. Should you borrow to invest? Well, short answer is yes. But again, I've got some rules. And in today's show, I'm going to go through all 4 of these rules, and maybe that'll help you make that decision. Now, let me get this first one out of the way. And it's the easiest, and it's just refinancing the dead equity out of your home, okay? We call that dead equity because your home is not paying you anything at all monthly. You pay your home, right? Look at it this way. Let's say you have a home that is worth $400,000 and your mortgage is $200,000. Well, there's $200,000 of equity in that home that is not paying you. So that is one resource, and maybe the easiest resource that one can grab those funds and then invest those in cash flowing properties and continue that investment path, right? Go pull $100,000 out of that. And so now you have a mortgage at $300,000, but you have an extra $100,000 to continue that investing path, okay? So when I say borrow to invest, I want you to understand where we're going to go today is I'm not talking about conventional lending or mortgages or anything along those lines. Because yes, when we buy the single family homes or the apartment communities, there is a mortgage on that property. What I'm talking about is getting the funds together for those down payments to continue that investing path, okay? And I received a lot of feedback. So today's show, I want to break down how you get to, is this a good decision? And we're talking about personal loans. We're talking about HELOCs. We're going to talk about 401k loans, that sort of thing. So yes, should you borrow to invest? My short answer is yes, but you have to understand we're borrowing to invest into a cash flowing asset. We're not borrowing to speculate. We're not borrowing to buy stock. We're not borrowing to buy land or Bitcoin or a new car. We're not even borrowing to pay off debt. None of that. This is strictly borrowing to invest into a cash flowing asset. So we're going to come back and we're going to break down those 4 rules after just a short break. My name is Mike Harrison. This is the Lifestyles Unlimited Real Estate Investor Radio Show.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. It's time to turn up the volume and fine-tune your passive income plan so you can create the lifestyle you've always wanted.
Welcome back to the show. Happy to be with you this morning. I'm your host, Mike Harrison. We're going to open the phone lines. If you have any questions about real estate investing, please give us a call. Our number is 855-497-4335, 855-497-4335. And I know a bunch of you pick up this show on podcast. And if you've got a question, you're listening to the show after the live broadcast on your podcast app, or maybe you catch us on the YouTube channel, Lifestyles Unlimited at YouTube. Feel free to email me, askmike@luinc.com, askmike@luinc.com. In fact, it was several emails I received after last week's show that was the inspiration for this week's show, because I had touched on, at the end of last week's show, borrowing to invest. And it was a big enough subject that I feel I need to go into some basic rules to wrap around that decision. Should you borrow to invest? And what I'm talking about, though, is borrowing money, right, at one rate for one time period to put it into a cash flowing, tangible, hard asset, whether that's a single family home or as a passive investor in an apartment community. Why would you want to do that? Well, we could take money at a single digit rate typically, and we can invest it into a cash flowing tangible asset that's going to pay us double and triple digit returns. Okay, did you hear that? Double and triple digit returns is what we're making on these properties. And if you're listening to this show for the first time, That's what we do here at Lifestyles Unlimited. We can teach you how to build real generational, foundational wealth and cash flow buying real estate assets, okay? And those are, we don't do land, we don't speculate, we don't do commercial properties. We do single-family homes, and we do apartment communities. That's it. Very basic, very simple. We follow a model. And I received several emails during the week from people that have borrowed to invest in these deals. Why would they borrow to invest? Well, at the time, the majority of these emails centered around, they weren't people just getting started. They were people that had already invested in several properties. And essentially, they had run out of funds, right? Everything they had was all in these various properties. And so they had no more, but they wanted to continue that path. Or a deal came across their plate, right? And they didn't want to pass on it. So they found a way to secure that capital so that they can continue their path. So one way I did it, honestly, years ago, I took out a 401k loan. Okay, I was still working, W-2 income, and I took out a $30,000 loan against my 401k. That might be one of the easiest no-brainers out there. And it was so good, I paid that off. I paid that $30,000 off, and I went back to the well and took a second one for $50,000. Why? To continue my investing path. I didn't want to have that downtime of saving. And I'm not saying saving's a bad thing if that's the path you choose. If you've got enough passive income coming in, some people are able to save and accumulate those funds rapidly. But if you didn't want to pass on a certain deal, you had to find those funds, okay? So that 401k loan for me was very simple. It was very easy. If that's something you want to do, call your plan administrator. There are rules behind it. For me, it was a 5-year note, and I believe it was 4% monthly. But I was able to borrow at 4% and put that in again into a deal that was double and triple digit returns. So I've developed 4 rules should you borrow to invest. And rule number 1, for me at least, you need enough discretionary income now to cover the loan payments before taking on the loan. You need enough discretionary income now to cover the loan payments before taking on the loan. What does that look like? Well, that 401k loan, I remember my payments were about $600 a month. Now, at the time, I had about $2,500 a month in passive income coming in. So 25 less the 600, that was a no-brainer for me. There was, in my assumptions, where I was financially, that was a zero risk. I had 25 a month coming in. I borrowed to such a degree that it was a $600 debit monthly. Okay. Now, the other thing I did at the time, I stopped feeding my 401k as well. What do I mean by that? Well, you feed a 401k. If you have a 401k, they're taking money out of your check, your W-2 income, and they're putting it into the 401k. So you're feeding it. But when was the last time your 401k fed you, sent you that monthly check? Oh, yeah, they don't do that. So I turned that off. I had the $2,500 a month in passive income and borrowed to such a tune that it was $600 a month. Paid that loan off and did it again. Now, I do know some experienced real estate investors that will save a little bit, okay? Say they'll have $5,000, $10,000, maybe $15,000. And then they'll borrow on a personal loan based on the return of the investment being enough to cover. I don't recommend that for someone who is not experienced enough and to understand the deal, okay? That's a little bit of a gamble if you're just starting out. But if you're very experienced and you know the deal you're looking at well enough inside and out that it's going to cash flow to, and these are very predictable. This is a mathematical equation for us. We have to look at dozens of properties until we find that one property that does fit. And then if we're able to take it down, by that time, we know what it's going to cash flow. How do we know that? Well, we know the value based on the neighborhood, the after-repaired value. Our lenders have helped us in that regard, and we know what the rents are going to be in the neighborhood. It's easy to run a report and find that out. So again, I don't recommend doing that. Now, one thing I did do, I had a house that was for sale, and I had a contract on this house, but we weren't going to be able to close for about 40 to 45 days. Now, I had a deal come across my plate that I wanted to get into, and it was an apartment community as a passive investor. I didn't want to pass on that deal. So I called my bank and I took out a personal loan for $50,000. You may be thinking, well, Harrison, that's a bit of a risk. Follow me here. I had a house that was selling that was going to close in 40 to 45 days. Now, that personal loan was about 8%. But how long did I have that personal loan? Well, my friends, I only had that loan for about 2, maybe 3 months. As soon as that home closed and I received the funds from the transaction of the sale, I immediately paid that personal loan off. So literally, I think it was maybe 8 weeks that I had that loan. For me, that was a great move on my end. It was just a short term. I wanted the funds. I didn't want to pass on the deal. I knew that if I had to save up those funds, and you've got to act quickly, that the deal would have passed. I would have missed that opportunity to jump in. And I'm still part owner of that apartment community, and it continues to pay me quarterly. But that was several years ago. So that was one way that I borrowed. But remember, that rule number 1, and there's 4 rules that I have if you stick with me, but that rule number 1, you need enough discretionary income now to cover the loan payments before taking on the loan. That minimizes the risk. We'll be right back. My name is Mike Harrison. This is the Lifestyles Unlimited Real Estate Investor Radio Show.
And now a word on retirement from Del Walmsley.
The average person thought they retire at 59 and a half, 60, then they said 64, then it was 65, then it was 66, then all of a sudden they jump right to 70. 70 is the new 59, 70 is the new 64. Then it was, hey, most people are going to work all the way into their 80s.
Do you really want to work in your 80s? Or would you like to retire in 5 years or less? Find out how on Lifestyles Unlimited's live online free workshop. Register at lifestylesunlimitedworkshop.com.
We're back with the Lifestyles Unlimited Real Estate Investor Radio Show. We're here to answer your questions and help you become financially free.
Good morning. Happy Sunday. My name is Mike Harrison. Happy to be with you this morning. Hope you're enjoying the show. Before we get back to my 4 rules on borrowing to invest, and again, if you're just now tuning in, I'm not talking about mortgages or what have you. We do have a mortgage on every property. We bring a bank to the table every time. They're our biggest partner. What I'm talking about is personal loans, alternative loans, different means of securing that capital to continue that investing path, right? To take down that hard, tangible asset. If you have one come across and you don't want to pass on it, but you don't have the means to get into the deal, what do? Well, you need to go find that capital. But before I get back to my 4 rules on that, I want to mention our Expo. We have announced the dates for our Lifestyles Unlimited Expo in 2021, and those dates are April 29th, April 30th, and May 1st. April 29th, April 30th, and May 1st. That's in Houston at the George R. Brown Convention Center. Now, if you've never attended the Expo, my friends, I'm not saying this lightly, it is the greatest real estate networking event in the country, hands down, and it's the largest event of its kind. Where can you get more info on that? That's lifestylesunlimitedexpo2021.com, lifestylesunlimitedexpo2021.com. You can network there, connect with successful investors. I'll be there, industry experts, learn how to become real estate retired at any age. There's breakout sessions, classes, vendor booths, and my friends, basically come experience what we do. Come experience these life-changing principles that will set you free. That expo is an incredible experience. I highly suggest you write those dates down, April 29th, April 30th, and May 1st, and find a way to attend. You will be happy you did. Trust me. Okay, continuing. Talking about this borrowing to invest, I received an email from a gentleman, and he said he uses 0% credit cards. He'll get a deal for 18 months or what have you, and he's able to utilize that in such a way to fund a purchase or to continue his investing path. I'm not sure if I think if you take money out against a credit card, that 0% goes away. I'm not sure. Maybe he uses the credit card to fund his current financial lifestyle, what have you, and then is able to free up the funds a different way to invest in the deal. I thought that was clever. This person says they've done it several times. Thinking of that, I want to say Del Walmsley, and I've heard him talk about this before on some of his past shows. I want to say he purchased an apartment complex back in the 80s with several credit cards. Maybe it was the late 80s, 20 to 30. Now, there's no such thing as a 0% interest deal at that time. And I'm not recommending you do this. I'm just kind of throwing it out, food for thought. But Dell discusses when he talks about that, he had a huge spreadsheet that he had to lay out for his banker, and he had all this, he's able to put 5 on this one, 10 on that one, 15 on that credit card, whatever the number was. But he was financially savvy enough to manage that, and he knew that this investment in this apartment complex, he had done his homework, was going to cash flow at a certain rate that was greater than what he needed to pay those cards off. So that was my rule 1, was to make sure you have that cash flow in place and understand what you're doing. This leads me to rule 2, okay? Rule 2 is the loan needs to be set and stable. The loan needs to be set and stable. What do I mean by that? I mean defined terms, no sudden calls, okay? Let's keep in mind, we're borrowing to invest in an asset. This is not a life or death situation, all right? This is totally discretionary. Essentially, treat this as a luxury. Don't go borrow from your bookie, so to speak. I think you know what I'm saying, to invest in these assets by any means. So for me, that 5-year 401k loan with set payments was extremely stable. Now, I didn't take 5 years to pay it off, but it was set. And there was no prepayment penalty. So make sure your loan is set and stable. It doesn't have a prepayment penalty, because the whole idea is just to secure these funds for a short amount of time and then, boom, pay it off. An interest-only HELOC, for example, I believe there's 10-year interest-only HELOCs that are out there. That's very stable, okay? Now, don't take 10 years to pay it off. I know that some people may do that, but that's not what I'm advocating here. Back to that 0% interest credit card, it has a shortened time frame, 18 months. If you're okay with that and you have the funds to cover it and you know what you're doing, that's stable, right? But make sure the means are there to cover, and these loans are fine. So make sure that that loan has defined terms and it's set and stable. It doesn't have any sort of waterfall interest kicker, right? Let's say you're borrowing at 4%, but there's a waterfall after a certain date and it bumps up to a double-digit rate. That's not something I'm interested in, okay? I want it to be set and stable. Now let's talk about saving, right? Nothing wrong with saving to build up enough to continue to get into another asset. I'm always doing that. But there's a huge danger, I believe, in today's monetary, the rules of money today, into folks that are sitting on piles of cash. I think that is extremely dangerous. Now, if you're listening to me, you may be going, Harrison, you're crazy. What's wrong with that? Well, let's look at it, because I may think this is even generational. The older generation tends to have a lot of cash. Why? Well, that was a good plan 40 years ago. You had stable interest rates that were 6, 7, 8, 10%. And so that was a smart plan to get ahead. If you had a ton of cash and you can make those kind of rates of return just by saving it, yes, that's a good plan. But where are we today? Today's world, savers are losers, my friends. Savers are losers. Having that big pile of money or a big pile of cash sitting around, what's going on? Well, I know the published inflation rate, if you look at the Fed, they're always aiming for 2%. Personally, I think it's a little higher. We might not have all the information on that. So if you're sitting on, $100,000, next year it's going to be worth at least 2% less. And then the year after that, 2% less, 2% less. Now, I can hear you. You're saying, no, Harrison, I'm putting it in the bank and I'm making a rate of return. Okay. The best I was able to find was 0.05%. Let's say that again. The best I was able to find for just typical savings plan, savings account at a bank was 0.05%. Do you realize how pathetic that is? $25,000 in the bank at 0.05% will pay you, drumroll please, $12.50 a year. That's $1.04 per month, okay? Why are savers losers? Because you can take that $25,000 and let's just say you buy a single-family home, right? You invest it into a single-family home. Now, let me show you the kind of returns you get here. We make money 5 ways. First and foremost, cash flow, $400 a month on average. Okay, that $400 a month versus the $12.50 per year, that's 32 times greater return to take that money and put it in a single-family house. And that's just one way, okay? I don't even want to annualize what that difference is. It would be 12 times 32. So you can save it and make $12.50, or you can buy a single-family home using our model and make $400 in cash flow. Now, the second way, mortgage pay down. There's about another $100 a month coming in your pocket. So right there, call that $1,200 a year. That's 100 times better than savings. We're going to continue this discussion. We'll be right back after a short break. My name is Mike Harrison. This is the Lifestyles Unlimited Real Estate Investor Radio Show.
One of the things I'd like to get across is that your whole life you wanted to make a change, right? But you never had the time. This might be it, because we have online education that you can get involved in.
We're now going to bring the free workshop to the entire country and really the world. Anybody who is interested can participate in that. We're going to live stream that free workshop and have people online with you on the live stream, talking with you, answering questions, interacting. You're really going to get a great feel for the Lifestyles community from this. And you can register for that. So if you want to find out about us, this is a great way to take a look at us and what we do.
Lifestyles Unlimited has been helping people succeed since 1990. Join us for our free online real estate workshop and learn the 7 principles we teach to run our businesses and provide for our families. Register at lifestylesunlimitedworkshop.com. That's lifestylesunlimitedworkshop.com.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. Now, let's get back to your map to financial freedom.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show, where, as always, we're working on your financial freedom. I'm your host, Mike Harrison. If you have any questions regarding today's show, feel free to email me, askmike@luinc.com. askmike@luinc.com. In fact, today's show is an inspiration due to the numerous emails that I received during the week discussing, should you borrow to invest? And that's what we're talking about today. Should you borrow to invest? I have some rules behind that. My short answer is yes. Okay. Yes, absolutely you should, because you're able to borrow at a single-digit rate of return and invest into a property that's going to provide a double and often triple-digit rate of return when done correctly. And that's what we teach you here at Lifestyles Unlimited. We are a educational and mentoring group that teaches real estate investing. We've been around for 30 years. We have a YouTube channel. You can pick this show up there. We have podcasts. Go to your favorite podcast app, listen to the show. Find the Lifestyles Unlimited Real Estate Investor Radio Show. Go to the website. You can click on it there and catch all the radio shows. So not just mine, but you'll get Andy Webb, you'll get Al Gordon, and you'll get Del Walmsley. So, rule number 1, and these are my rules, okay? Feel free to reach out to me if you want to discuss. But rule 1 was you need enough discretionary income now to cover the loan payments before taking on the loan. For me, that makes it stable. Rule 2, speaking of stable, the loan needs to be set and stable. Okay, set and stable. It needs defined terms. It doesn't need sudden calls, okay? Don't get some crazy loan from somebody that 2 months later down the road, they're going to go, hey, yeah, you know what? I need you to pay me back. That's not a good idea by any means. So that leads me to rule 3. You must borrow at a rate of return lower than the return of the investment, okay? Now, that's a no-brainer, right? You're going to borrow at single-digit returns, and you're going to put it into a cash-flowing, tangible asset that's going to provide those double and triple-digit returns. And in the last segment, I showed you just 2 ways, right? The monthly cash flow and the mortgage pay down. When the resident pays the rent, you pay the PITI, right? Principal, interest, tax, and insurance. Everything left over after that is cash flow. But the mortgage pay down itself is 1,200 times better than what you would get on just saving that same $25,000. Savers today, put your money in the bank and just set it in there, which is, it's a habit from the 20th century when it made sense, but today's, you're losing if you're saving money. Earning sub 1% rates of return, you put inflation on top of that, I think you can see that sitting on a large amount of cash for a substantial amount of time is not the smartest, most effective thing you can do with that. I advocate putting it into some real estate that's going to take that money and it's going to churn it, and it's going to churn it, and it's going to churn it, and it's going to provide those returns 5 ways on a single-family home, 6 ways on an apartment community. And if you can borrow at, say, sub 6% or less and have the ability to pay this down immediately, provided you invest right away, for me, it's a no-brainer. Just follow those rules that I have. And I mentioned 3 rules. I've got a 4th one that I'm going to get to before the end of the show. But I do have a question. At what point does a cultural behavior become conventional wisdom? Let's think about that. At what point does a cultural behavior become conventional wisdom? And within that conventional wisdom, if everybody's doing it, it begins to feel safe, right? Everyone thinks that these behaviors are safe because everybody else is doing it. But I'm just thinking out loud. 1999 to 2000, the tech bubble. I remember getting in a cab one time, and the cab driver was giving me stock advice on what he was buying. Now, maybe he was a part-time financial analyst. I need to give him some sort of credit, but just at face value, I'm thinking, holy cow, this guy is telling me about stocks and that sort of thing. Now, I didn't know that we were in the middle of a bubble, but when I look back on that with my wisdom, I'm like, how do you know when you're in a bubble? Well, when your cab driver's telling you what stock to buy. I knew a guy, he was an associate where I worked, and this guy took an Amex card and put $50,000 of Qualcomm stock on this credit card. When did he do that? He did it in January of 2000. What happened in March of 2000? The thing went away. I don't know what happened to the. I don't want to know. I'm sure it ended poorly, but because I remember Qualcomm looking at it after March and thinking back to this individual going, "Holy cow, what the heck happened?" My friends, that's not borrowing to invest. That is a crazy gamble, speculation, insane move. I'm not advocating that by any means. Think about the housing crash in 2008. You had people buying houses that had no business buying houses. But the thing was conventional wisdom. Go get a house. Everybody's doing it. This is what you're supposed to do. Well, I look at people sitting on mountains of cash today in the same way. It's a conventional behavior that everybody thinks is safe because everybody else is doing it. And I'm not sure that it's all that safe, okay, especially with inflation and especially with the rates of return that you get. All right, so let's review these 3 rules. And I'm going to get to the 4th one here in a sec. But rule 1, if you're going to borrow to invest, you need enough discretionary income now to cover the loan payments before taking on the loan. Rule 2, the loan needs to be set and stable. Defined terms, no sudden calls. Rule 3, you must borrow at a rate lower than the return of the investment, okay? So again, if you can borrow at 3, 4, 5, 6%, and you're able to put it in an investment that's cash flowing 8 to 12%, you're getting an equity capture plus the mortgage pay down plus the tax advantages. Well, that makes all the sense in the world. Now, rule 4. Maybe some folks that debate me on this, but I'm going to tell you right now, rule 4 is it must be a safe investment. And by that, buying a single-family property when you've done your homework and you understand what you're doing and you're educated, a hard, tangible, cash-flowing asset, that is an extremely safe investment, my friends. Much safer than the stock market. I've never woke up and Wall Street did something and suddenly my house was worth 40% less. That's never happened to me. Never. I've never woke up and my houses had gone to a nothing value because Wall Street sneezed. Guess what? Rent's due on the 1st. It continues to chug along. Same thing with our apartment communities. So when I say it must be a safe investment, I don't want you to set yourself up with a double liability, okay? What happened to the guy I knew that put $50,000 of Qualcomm stock on his Amex card in late January 2000? Well, the crash was in March. That was a bad deal. So Dale Walmsley actually says it better than I do. He'll say, before we discuss the return on my investment, let's discuss the return of my investment. That's his way of saying, put your money in somewhere that's safe. These financial guys, people go see them and they want you to diversify and put your money here and put your money there and put your money there and put your money there. And then they start talking about the return on my investment. Well, again, before we discuss the return on my investment, let's discuss the return of my investment. Again, I've never had a rent home depreciate 10, 20, 30, 40% overnight, over a week, over a summer, over a season. But stocks do it all the time. Homes are hard assets. They don't lose confidence. They don't fall out of favor. They cash flow and appreciate year in and year out. And my friends, people will always need a place to live. Now, do we have some home values go down in 2008? Yes. But if your property's stable, there's still a resident living in there, and they're still paying that monthly rent, month in and month out. So we're able to make money in the up times and the down times, both sides of it. So when I say it's a safe investment, that's what I mean. So my friends, if you're considering borrowing to invest, 1, you need enough discretionary income now to cover the loan payments before taking on the loan. 2, the loan needs to be set and stable, defined, no terms, no sudden calls. 3, must borrow at a rate lower than the return of the investment. And 4, it must be a safe investment. So my friends, if you got any questions, reach out. Happy investing, but those are some strategies you can use to continue your investing path as you continue building that passive income and growing that generational wealth.
The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented on the Lifestyles Unlimited Real Estate Investor Radio Show constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.